Trump's impact? Dollar's power weakening? Silver and gold soaring. A single presidential demand just triggered what central bankers feared most. The world's reserve currency, standing at the edge of a structural break. Gold crossed a threshold that changes everything. Silver moved 6% in hours, not days. The dollar index losing grip on a line held for over a decade. But here's what nobody's connecting yet. There's one specific level, one precise breaking point where this stops being a market story and becomes a wealth preservation emergency. That level, we're tracking it right now. And if it snaps, welcome to John Analyst. Now, before we go any further into what's actually happening behind these numbers, I need to ask you something important. You've been watching financial markets long enough to know the real moves happen when nobody's paying attention. This channel exists for people like you, the ones who've seen cycles before, who understand that preparation beats panic. So here's what I'd appreciate. Hit that subscribe button right now. Not because I'm chasing numbers, but because when critical moments like this unfold, you'll want this analysis in your feed, not buried somewhere you'll never find. And drop a comment below. Tell me where you're watching from. London, New York, Singapore, Mumbai? Because what's happening to the dollar, what's happening to precious metals right now, this isn't just an American story anymore. It's global, and your perspective matters. Now, let's get into exactly what this breaking point means, and why the next 30 days could redefine your portfolio strategy. On a morning that seemed ordinary to most, a statement landed in financial markets with the force of a policy earthquake. Not a tweet, not a rumor, a direct demand. We should have the lowest interest rates in the world. Those 11 words, spoken by a president who views currency policy as negotiation leverage, just redefined the rules governing $75 trillion in global reserve assets. And here's what makes this different from typical political noise. The markets believed him. Within hours, the dollar index began behaving like a currency that just lost its gravitational center. The technical chart that traders monitor obsessively, the one tracking dollar strength against a basket of major currencies, cracked below a support line it had respected since 2011. Not tested, not touched, cracked. That line sat at approximately 102.5 on the index. For context, that level had served as a floor during every major crisis of the past decade. The European debt crisis, the pandemic sell-off, the inflation surge of 2022. Every time global uncertainty spiked, capital fled to dollars, and that technical floor held. Until now. When a 14-year support structure breaks, it's not a chart pattern. It's a regime change signal, and the implications extend far beyond technical analysis. Consider the mechanism at work here. The dollar's strength for the past 40 years has rested on three pillars. First, the United States maintaining relatively higher interest rates than other developed economies. Second, the dollar's role as the primary reserve currency for global trade and central bank holdings. Third, the perception of American political and economic stability. That first pillar just received a direct assault from the Oval Office itself. When a sitting president demands the Federal Reserve lower rates below every other major economy, he's not making a request. He's telegraphing policy intent. And markets don't wait for official implementation. They front-run the probability. The mathematics becomes straightforward. If U.S. interest rates drop below those of Europe, Japan, even emerging markets, the interest rate differential that has pulled capital into dollars for decades reverses. Capital flows follow yield, always have, always will. And here's where precious metals enter the equation with mathematical precision. Gold and silver don't need bullish news to rise. They need the absence of opportunity cost. When dollars yielded 5% risk-free, holding gold at 0% yield made little sense for large institutional allocations. But when that differential compresses, when real rates adjusted for inflation turn deeply negative, the opportunity cost of holding metals evaporates and something else happens. Gold, which had been consolidating near $3,000 per ounce after a historic rally, suddenly found aggressive buying, not speculative buying, defensive accumulation. The price action told a specific story, a surge to new highs, a sharp correction that shook out weak hands, then a recovery that trapped short sellers. And now, a base forming right above 3,000. That pattern has a name in technical analysis. It's called a bull flag, and it appears when strong hands are absorbing supply. Preparing for the next leg higher, silver responded with even more violence. A 6% intraday surge, the kind of move that only happens in small markets when large capital arrives suddenly. But let's be precise about what's actually breaking down here. The dollar index measures American currency strength against euros, yen, pounds, Canadian dollars, Swedish krona, and Swiss francs. When that index loses structural support, it means confidence in dollar stability is eroding across multiple major economies simultaneously. This isn't about one central bank's policy. It's about the global financial community recalibrating risk around the world's reserve currency. And recalibrations of this magnitude don't happen quietly. The last time the dollar experienced a structural breakdown of similar magnitude, from 2002 through 2008, gold rose from $280 to $1,000 per ounce. That's a 357% gain. Silver, during that same period, moved from $4.50 to $21, 467%. The current setup carries echoes of that period, but with one critical difference. The debt burden now sitting on sovereign balance sheets globally is exponentially larger. U.S. federal debt exceeds $36 trillion. Deficits are running at $2 trillion annually in an economy supposedly near full employment. That's not recessionary emergency spending. That's structural fiscal dominance. And fiscal dominance, the condition where government debt becomes so large that monetary policy must accommodate it, regardless of inflation consequences, creates one mathematical certainty. Currency debasement becomes inevitable. Gold doesn't care about politics. It responds to debasement. And right now, debasement just received presidential endorsement. The question facing serious capital allocators isn't whether precious metals respond to this environment. The question is, how violently and how fast? There's a moment in every bull market that separates believers from strategists. It's not the breakout, not the new all-time high, not even the parabolic move that makes headlines. It's the consolidation that comes after, the boring phase, the sideways grind, the period where nothing seems to happen, where impatient traders exit, where analysts start questioning whether the move was real. That moment is where fortunes position themselves. And gold just entered it, $3,000 per ounce. A psychological barrier that once seemed absurd is now functioning as support, not resistance, support. Let that reality settle for a moment. 5 years ago, gold trading above 2,000 was considered extreme. Today, 3,000 is the floor where institutional buyers are defending positions. But here's what makes this consolidation different from typical profit-taking pauses: the internal structure. In late January, gold surged to $3,150, a vertical move that triggered every overbought indicator on technical charts. Predictably, profit-taking began. The metal sold off hard, dropping back toward $2,900. Traders who bought the top panicked. Short sellers piled in. Financial media declared the rally over. Then something unexpected happened. Gold reversed, not slowly, violently, within days. It reclaimed 3,000 within a week. It was testing 3,100 again. That recovery, that refusal to collapse despite overbought conditions, told professional traders everything they needed to know. Strong hands weren't selling. They were accumulating dips. And when strong hands defend a level, that level becomes a launching pad. Now, let's examine why 3,000 specifically matters beyond psychology. From a Fibonacci retracement perspective, this level represents the 61.8% retracement zone of the entire rally from the 2,200 base to the 3,150 peak. In technical analysis, the 61.8% level is considered the deepest retracement a healthy bull market typically allows before invalidation. Gold touched it and bounced immediately. That's not random, that's structural buying. But there's another layer here that most surface-level analysis misses: volume patterns. During the initial rally to 3,150, volume was explosive, heavy institutional participation. When the correction began, volume stayed elevated. That suggests distribution, selling pressure, except the price didn't collapse. When selling volume is high, but price decline is shallow, it means aggressive buying is absorbing that supply. Someone, or multiple large entities, are stepping in front of every wave of selling and taking the other side. Who buys aggressively during corrections in an asset already near all-time highs? Entities who believe current prices will look cheap 12 months from now. Central banks provide a partial answer here. Data from the World Gold Council shows central bank purchases remained exceptionally strong throughout 2024. China, Russia, India, Poland, Singapore, Turkey, nations holding massive dollar reserves, systematically converting portions into gold. That's not speculation. That's strategic reserve diversification based on currency debasement expectations. And here's the critical insight most retail participants miss. Central banks don't trade, they accumulate. They don't care about catching bottoms or timing perfect entries. They care about structural allocation shifts over decades. When central banks buy during a correction, they're not betting on next week. They're repositioning for the next monetary era. Now, overlay the options market data. The gold options market has seen a significant shift in recent months. Institutional players are building long-dated call positions. Strikes at 3,500, 4,000, even 4,500. Not lottery tickets. Serious premium deployment with expiration dates extending into 2026 and beyond. That kind of positioning reflects institutional conviction, not speculative gambling. These aren't retail traders hoping for quick doubles. These are funds allocating millions into structured positions that only make sense if gold breaks significantly higher over the next 12 to 24 months. But let's stress test this thesis. What would invalidate the bullish structure? A breakdown below 2,800 would represent a failure of the entire consolidation pattern. It would suggest the rally was exhausted, that institutional support has vanished, that the thesis is broken. The probability of that scenario, based on current market structure, sits below 20%. Why so low? Because the fundamental drivers haven't weakened. They've intensified. Real yields, the return on government bonds after adjusting for inflation, remain deeply negative in much of the developed world. U.S. 10-year treasuries yielding 4.3% sound attractive, until you subtract actual inflation running closer to 4%. That's 0.3% real return, in an environment where fiscal deficits guarantee future inflation pressure. Gold, yielding 0, suddenly doesn't look like the opportunity cost problem. It looks like the preservation solution, and preservation demand, the kind that comes from institutions managing multi-billion-dollar portfolios, doesn't create sharp V-shaped rallies. It creates steady, relentless, structural buying that grinds prices higher over quarters and years. The pattern emerging in gold right now mirrors almost exactly what occurred from late 2009 through 2011. A sharp rally, a correction to the 61.8 retracement, a base building phase lasting several months, then a breakout to new highs that ran for 18 months. Gold went from 1,100 to 1,900 during that final leg, 73%. If the current structure follows similar proportions from a 3,000 base, the mathematical projection extends beyond 5,000. But projections mean nothing without catalysts. The catalyst is already in motion. Presidential pressure on the Federal Reserve, fiscal deficits requiring monetary accommodation, a dollar losing structural support, and one more element that hasn't fully activated yet: retail participation. This rally so far has been almost entirely institutional. Retail investors, burned by the long consolidation from 2011 to 2019, remain skeptical. But skepticism, in bull markets, is fuel. The moment retail FOMO begins, when headlines scream about gold breaking 4,000, when your neighbor starts asking how to buy precious metals, that's when the final parabolic phase begins. We're not there yet. Which means, for those paying attention, the window remains open. If gold is the strategic reserve, the anchor, the wealth preservation instrument of empires, silver is the wild card that nobody sees coming until it's already doubled. And right now, silver is doing something it only does before explosive moves. It's coiling. 6% intraday surge. That's not normal price discovery. That's not gradual accumulation. That's panic buying in a market too small to absorb sudden demand without violent price dislocations. But here's what makes silver fundamentally different from every other asset discussed in financial media. It exists in two worlds simultaneously: half industrial commodity, half monetary metal. And those two worlds are about to collide in a supply crisis that mathematics says is unavoidable. Let's start with the industrial side, because this is where the invisible deficit hides. Silver is consumed, not stored, consumed. Every solar panel manufactured requires silver paste for photovoltaic cells, roughly 20 grams per panel. The solar industry alone consumed 130 million ounces in 2024. Global solar capacity is projected to triple by 2030 under current climate commitments. Do that math. 3 times current consumption from one sector alone. Electric vehicles. Every EV contains approximately 1 ounce of silver in electrical contacts, circuit boards, and battery management systems. Global EV production is accelerating. 20 million units annually now, projected 50 million by 2030, another 50 million ounces, annual demand increase from one product category. 5G infrastructure. Each 5G base station requires substantially more silver than previous generation equipment due to higher frequency requirements and increased antenna arrays. Global 5G build-out is still in early phases. China alone plans to deploy over 2 million base stations by 2026. Consumer electronics, medical devices, industrial applications, water purification. Every modern technology relies on silver's unique properties. Highest electrical conductivity of any element, highest thermal conductivity, most reflective metal. And here's the problem. Global mine production peaked in 2016 at approximately 890 million ounces. Current production, 820 million ounces. Production is declining, while industrial demand is accelerating. That gap is being filled by above-ground stockpiles accumulated over decades. But stockpiles aren't infinite. The Silver Institute estimates identifiable above-ground investment stocks at approximately 2 billion ounces globally. Sounds like a lot. Except, at current consumption rates minus production, that buffer provides roughly 7 years of supply, 7 years before the physical market faces a deficit with no inventory cushion. But let's add the other side of the equation, investment demand. When investors decide silver is a monetary hedge against currency debasement, they don't consume it. They hoard it. They remove it from available supply. In 2020, when pandemic uncertainty spiked, investment demand for physical silver doubled. Premiums on silver coins and bars exploded. Mints couldn't keep up. Delivery delays extended to months. Price response? Silver went from $14 to $30 in less than a year, 114%. And that move happened before the current fiscal crisis, before presidential pressure on the Fed, before the dollar broke structural support. Now overlay the gold-silver ratio, currently trading near 85 to 1, meaning it takes 85 ounces of silver to buy 1 ounce of gold. Historical average over the past century, approximately 60 to 1. During monetary stress periods, that ratio compresses violently. In 2011, it dropped to 32. In 1980, 16. If the ratio simply reverts to 60, with gold at 3,000, silver reaches $50. If it compresses to 40 during a crisis, silver hits $75. From current levels near $32, that's 135% upside. But there's a mechanical reason why silver moves faster than gold that most analysis ignores. Market size. The entire global silver market, all mining production, recycling, and investment, represents roughly $50 billion annually in value. The gold market, 10 times larger. When large capital decides to allocate to precious metals, even a fraction of percentage points flowing into silver creates disproportionate price impact. $1 billion entering the gold market? Barely noticed. $1 billion entering silver? Seismic. And here's where the current setup becomes genuinely dangerous for those underexposed. Silver hasn't broken out yet. It's pressed against resistance, testing, probing, building energy. The technical chart shows a multi-year base formation between $22 and $30. Classic consolidation after the pandemic spike. But watch what happens when it breaks cleanly above 34. That level represents the breakout point from a 4-year consolidation pattern. Once exceeded with conviction, the next resistance doesn't appear until $43, $10 run, minimal resistance, in a market prone to vertical moves. The mining equity space tells a supporting story. Silver miners, the companies actually extracting metal from the ground, have dramatically underperformed the metal itself over the past 2 years. Normally, mining stocks lead. They're leveraged plays on the underlying commodity. When gold or silver moves 10%, miners should move 20 to 30%. They haven't. They've lagged badly. Which means one of two things. Either the market believes metal prices will collapse, or miners are massively mispriced relative to coming metal appreciation, given the supply-demand fundamentals, the dollar breakdown, the fiscal trajectory. Which scenario seems more probable? But let's address the bear case directly, because intellectual honesty requires it. Silver's industrial demand is economically sensitive. If global recession hits, industrial consumption drops, solar projects get delayed, EV production slows. That demand destruction could offset monetary demand. Valid concern. Historically accurate during severe recessions. Except, in this environment, recession doesn't eliminate the fiscal crisis. It worsens it. Governments respond to recession with spending, massive spending, financed by debt, monetized by central banks, which accelerates currency debasement, which drives monetary demand for silver even as industrial demand temporarily softens. And here's the element that changes everything about previous recession playbooks. Physical supply constraints didn't exist in previous cycles like they exist now. In 2008, silver dropped to $9 because there was ample supply. Mines could ramp production. Recycling could increase. Stockpiles were substantial. Today, mines are already running at capacity. New mine development takes 7 to 10 years from discovery to production. Recycling infrastructure is maxed, and stockpiles, as discussed, are being drawn down structurally. So even if recession temporarily reduces industrial demand, the supply side can't respond with increased availability. That's a different equation entirely. It means the next move in silver, when it comes, won't be gradual, it'll be a gap, a repricing. A moment where the market realizes there isn't enough physical metal available at current prices to satisfy sudden demand. And gaps don't give you second chances to enter calmly. They punish hesitation. Strategy without execution is philosophy. Execution without strategy is chaos. What matters now is translating analysis into actionable framework. Because understanding the thesis means nothing if capital remains paralyzed by indecision, or worse, deployed recklessly without risk management. So let's build the positioning architecture. First principle, asset selection hierarchy. Physical metals, mining equities, exchange-traded funds, futures contracts, option strategies. Each serves a different purpose. Each carries distinct risk profiles. And mixing them without understanding the trade-offs is how sophisticated analysis produces mediocre results. Physical gold and silver, The actual metal you can hold represents pure monetary insurance. No counterparty risk, no management fees, no operational complexity beyond secure storage. The advantage? In a genuine currency crisis, physical metal is the only asset that doesn't depend on functioning financial infrastructure. The disadvantage? Zero yield, storage costs, liquidity constraints if you need to sell quickly in size, appropriate allocation, core holding, the foundation. 10 to 20% of investable assets for those treating this as wealth preservation, not speculation. Exchange-traded funds backed by physical metal, GLD for gold, SLV for silver, offer liquidity and ease of trading. The advantage? Instant execution. No storage concerns. Easy to scale position size. The disadvantage? Counterparty risk. You don't own metal. You own shares, representing claims on metal held by custodians. In extreme scenarios, that distinction matters. Appropriate allocation, tactical positions, swing trading around core physical holdings, suitable for investors who need liquidity flexibility, mining equities. Companies extracting metal from the ground provide operational leverage to metal prices. When gold rises 10%, well-managed miners with strong balance sheets can rise 30 to 50% due to margin expansion. The advantage? Explosive upside potential during bull moves. The disadvantage? Company-specific risk, management execution, operational issues, geopolitical risk if mines are in unstable jurisdictions. And here's the critical point. Miners can collapse even when metals rise if costs escalate faster than revenue. Appropriate allocation, aggressive satellite positions, 5 to 10% of precious metals allocation, only for capital that can withstand a 50% drawdowns without forcing liquidation. Now, scenario planning, because markets don't move in straight lines, and rigidity kills portfolios. Scenario alpha, orderly dollar decline. The Fed gradually accommodates presidential pressure. Rates drift lower over 12 months. Dollar index grinds down to 95 without crisis moments. Gold appreciates steadily to 4,000. Silver reaches 50. Probability assessment, 35%. Positioning response, maintain core allocations, add on weakness, take partial profits on miners at predefined targets, rebalance quarterly. Scenario beta, disorderly dollar breakdown, geopolitical shock, debt crisis, sudden foreign central bank selling of treasuries, dollar index breaks 90 in weeks, not months, gold spikes to 4,500, silver gaps to 70, probability assessment, 25%. Positioning response, this is why you hold physical metal. ETF liquidity disappears in panics. Mining stocks become untradeable. Physical metal remains physical metal. Don't chase the gap. Either you positioned beforehand or you accept missing the move. Scenario gamma, policy reversal. Political pressure fails. Fed holds rates steady or even hikes into weakness. Dollar stabilizes. Metals correct sharply. Gold drops to 2,600. Silver revisits 24. Probability assessment 20%. Positioning response. This is why position sizing matters. If your metals allocation is appropriate, you can withstand a 30% drawdown without panic selling. In fact, you use it to add at better levels. Bull markets don't die from corrections. They die from broken fundamentals. And the fundamentals, debt trajectory, fiscal dominance, don't reverse from one policy meeting. Scenario delta, stagflation grind, slow growth, persistent inflation, Fed trapped between mandates. Dollar weakens gradually, but metals don't explode. They grind higher in volatile, choppy fashion. Probability assessment, 20%. Positioning response, most frustrating scenario psychologically. Requires discipline to hold through consolidations. Requires patience when price goes nowhere for months. But historically, this scenario eventually resolves into either alpha or beta. Now, timeline and trigger monitoring. The Federal Reserve meets 8 times annually. Next critical meeting, March 18th, June 17th, July 29th. Watch the language, not just the rate decision, the language in the statement, the press conference tone. If Powell begins acknowledging political pressure, even subtly, that's your signal. The independence facade is cracking. Debt ceiling. The United States will hit the statutory borrowing limit sometime in Q3 2025, based on current projections. Every debt ceiling crisis creates the same pattern. Political theater, market volatility, last-minute resolution, but each iteration erodes confidence incrementally. This time, with the president actively demanding lower rates while debt explodes, the political dynamics are different. Watch for funding stress in the treasury market, rising repo rates, unusual bid-to-cover ratios at auctions. Those are early warning indicators before headlines catch up. Dollar index technical levels, 98.5, critical support. Break below with conviction and momentum accelerates. 95, psychological barrier. Once breached, next support isn't until 90. For gold, 3,200 is the line. Clean weekly close above that level, And the measured move target extends to 3,700 minimum. For silver, $34, 4-year breakout level. Once cleared, price discovery mode begins. Now, portfolio construction principles for different capital bases. Conservative allocator, someone prioritizing preservation over growth. 70% physical gold, 20% physical silver, 10% cash reserves for opportunistic additions. No mining stocks, no leverage, pure insurance model. Balanced allocator, someone seeking appreciation with managed risk. 40% physical gold, 20% gold ETF, 20% physical silver, 15% quality mining stocks, 5% cash. Rebalance semi-annually. Take profits on miners if they double. Rotate gains into physical. Aggressive allocator, someone accepting volatility for maximum upside. 20% physical gold, 30% silver physical and ETF, 35% mining equity basket, 15% explorers and developers. This portfolio can double or halve. Only suitable for capital you won't need to access for 3 years minimum. Tax considerations matter more than most realize. Physical metals held over 1 year qualify for long-term capital gains treatment in most jurisdictions, but they're classified as collectibles. Maximum 28% federal rate in the US, not the standard 15 or 20%. Mining stocks, standard equity treatment, long-term gains at favorable rates. ETFs, depends on structure. Some are trusts taxed as collectibles, others are grantor trusts with different treatment. Consult jurisdiction-specific advice. A 10% tax difference on a 50% gain is 5% of your capital. And here's the element that separates professionals from amateurs, rebalancing discipline. If gold doubles and suddenly represents 40% of your portfolio instead of 20, you have a decision. Let it ride or trim back to target weight and lock gains? Neither answer is wrong, but having no answer, having no predetermined rule, guarantees emotional decision-making at exactly the wrong moment. The institutional approach? Set bands. If allocation exceeds target by 50%, rebalance half the excess. If gold allocation is 20% and it grows to 35%, that's 75% above target. Trim 7.5% back. Mechanical, emotionless, profitable over time. Final point, on timing and urgency. Nobody can predict exact tops and bottoms. Nobody. But probability-weighted decisions based on asymmetric risk-reward, that's achievable. Current setup in precious metals. Downside appears limited by strong technical support, institutional accumulation, and deteriorating dollar fundamentals. Upside, based on historical precedent during similar monetary environments, extends 50 to 150% over 12 to 36 months. Risk-reward asymmetry, heavily skewed positive. The question isn't whether to position. The question is whether you position deliberately now, with sizing appropriate to your risk tolerance, or whether you wait for confirmation and pay substantially higher prices for substantially less upside. Markets don't reward hesitation. They reward preparation. And right now, the preparation window, while still open, is narrowing.